But with yields rising, investors are now looking to companies and sectors that offer better immediate value, with some analysts calling a rise in yields kryptonite for tech stocks. And here to get us up to speed with market moves today, we're joined by Yussef Gheriani. He's Director Investments Operations at IHT Wealth Management, speaking to us from Chicago today. Yussef, so the prospect of the Fed slowly removing the punch bowl is starting to sink in. Investors seem to be selling off bonds before demand cools down. And the 10-year Treasury yield has changed course dramatically, touching its highest since June. So how will this shape the markets in near term?
So I think this is more about people are afraid there's going to be a policy mistake of some sort at the government level. Interest rates are not really the issue. I think everybody knew that we're probably going to end the year around 2%. That's kind of been baked in. People are thinking somewhere between 1.5 and 2 on the 10-year. People knew that they're going to take the punch bowl away, and the Fed's been, they've done everything they can to try to be really clear and really transparent about that. So I think what you're seeing today, it's a combination of, yes, they might take the punch bowl away, but people are actually getting a little bit more afraid that maybe the U.S. government is not, they're not going to have this stuff together. They're not going to be able to raise the debt ceiling in time. They're not going to be able to give, the markets the kind of support that they need. So this is really, I think, more concern about a policy mistake in Washington than it is about the Fed not being transparent and being forthright and communicating what they're going to do.
So, Yussef, the speedy rise in rates, definitely not welcome news for holders of tech shares, which hit the skids overnight. How do you see this, though, this time around, this rotation out of tech? A buying opportunity, or are we past the peak of tech's rich valuations?
Tech's the place you got to be over the next couple of years. We're going back to a low GDP environment. We're going back to 2% GDP growth. We don't know if it's going to be in 6 months or if it's going to be in 12 months, but the stimulus that we put in during COVID-19, that's not going to be here forever. And when you take the stimulus away, nothing fundamentally changed in the U.S. economy. We're going back to that slower 2, 2.5, 1.5, 2% GDP growth. In that environment, you want companies that can grow, top line earnings in a kind of a sustainable way, and people are going to be willing to pay up for that. So over time, we think that growth is here to stay. And this is an opportunity for you to kind of go out and grab some of those high-quality names if you see big discounts. So definitely be out there, look for opportunities, buy the dip. Volatility is normal, and take the opportunities when they're presented to you.
All right, you're saying that opportunities are still there, but the imminent slowdown of bond buying is a sign of confidence in the Fed's belief that the U.S. recovery will continue. But a lot of bricks in Wall Street's wall of worry, the pandemic, inflation, divisions over raising the U.S. debt ceiling, a global energy crunch. What are your top concerns, though?
Top concern's got to be Washington. It's got to be a policy mistake. All the other headwinds, they get worked out. Supply chains are here. Yes, it's a problem. But the consumer's strong and they can handle some price increases if it's absolutely necessary. We're not super concerned about inflation, in a similar vein. It's here for another 6 months or so. A lot of it's supply chain related, and those kinks are going to get worked out. New entrants will come into the market to provide supply. So really, the top concern has got to be COVID on one hand, and then policy mistake. We think that COVID, the scientists have done a great job. The vaccines are working. In the last month or so, we've given out more than 1 billion shots globally. So there's progress being made there, and scale is coming to address that problem. And so really, it comes back to what's the biggest risk on the table? Policy mistake. Somebody screws something up, something that's totally avoidable. We don't pass that ceiling, we don't raise it. And that's something that's totally avoidable. And so really, we're all looking here and hoping that this is some short-term volatility and opportunity to buy, and not something that's bigger that's going to be self-inflicted.
So, Yussef, policy mistakes aside, in terms of investment strategy, you say investors need to be selective, as some companies really are being priced more on hope than on fundamentals. What exactly do you mean by this?
So even though tech is a place we want to be, there's definitely some tech companies that are kind of up and over their skis. There's not a lot of fundamental reasons why you would own them if you just do math. So I think examples of that, as much as I love the technology, Tesla is kind of an example of a company that's been bid up beyond the fundamentals. Love the product, but it doesn't necessarily mean that the math makes sense, right? But at the same time, you've got a lot of other companies out there within the tech space that are fundamental to, that they're key kind of building blocks of the modern economy. So think about all of your chip names, right? Your Lam Researches of the world, your Applied Materials. Those companies are the building blocks of the future, right? We're going to use chips in everything. And so when you see those guys go on sale, when those folks are discounted, I think they've sold off some 6% or so today, maybe more by the end of the day. Those are opportunities to buy high-quality names that are integral to the future of technology, the future of just kind of building the economy. So take your opportunities to buy stuff, but take your time and do some math before you jump in and make sure you really know what you're going to own.
Fantastic stuff. Thanks for the optimism. Yussef Gheriani, Director, Investments Operations at IHC Wealth Management, speaking to us from Chicago. Thank you for your time today.